Too tardy. All right, well, thank you everyone for joining us. Welcome to Warren Street Wealth Advisors Where Are We Now presentation. I feel like I wake up every day saying that to myself, where are we now? Groundhog Day and COVID and isolation. My hope is after the next hour or so, you guys walk away with some perspective on where we've come from through COVID from a market sense, an economic sense, and you feel more informed and confident about the path forward. Some basic housekeeping before we go further, just some legal disclosures. Let's see here. We are a registered investment advisory firm with the Securities and Exchange Commission. Each year, we are responsible for filing what's known as a Form ADV. This is a lot of legalese about our firm structure, operations, fees, conflicts. Each client does receive this already automatically, but if you ever did want to re-request a copy, you have the ability to do so via phone or email. In this disclosure, the thing I want to stress even more than this is nothing on today's webinar is meant as personal, actionable advice. So don't leave here and take more risk, take less risk, change your tax withholdings, take money out of the market, et cetera, before consulting with your personal planner, your tax advisors, hopefully your folks here at Warren Street before taking action. Before we get into the real technical jargon, just wanted to give everyone a little bit of a moment of levity. Give yourself a moment to view this cartoon. Full disclosure, I don't know if it was dad brain or just 2020 brain, but it took me a minute to put together that this was Atlas holding up the weight of the world on his shoulders. In this sense, the global economy. I think they should have substituted Jerome Powell, the Fed chair of the Federal Reserve here in the United States, because while he's been busy with a monetary stimulus cannon to the tune of trillions of dollars and keeping the economy afloat, or at least to a certain degree, we've all just been sitting at home doing our thing. So that made me chuckle a little bit. Hopefully did the same for you. So who are we? Again, we are Warren Street Wealth Advisors, and a lot of you folks obviously already know us, but just want to drive home a few key points. We are obviously located here in Tustin, California. Our team oversees, as of this week, just shy of $175 million in assets across just over 260 households and businesses. And we were co-founded by myself, the ginger in the middle there, and my business partner, Carrie Facer. I call him the silver fox in the middle, back in 2015. And one of the things that I think makes us most unique in the space is, a lot of you on this webinar started working with our team back when it was just, Carrie as a solo practitioner or myself as a solo practitioner. And that was not the long-term vision of what we were trying to build or what we were trying to accomplish. Our hope was to build something more enduring and to build an ensemble. And we've been true to that message. So we're trying to build a team of experts, different core competencies, and continue to scale and reinvest in our business, and obviously reinvest in each and every one of you and drive more positive outcomes for you. So when I talk about different core competencies, it's folks that are specialized in planning, folks that are specialized in tax, investments, business development, client service, and today, you're going to be hearing specifically from the investment-centric folks on the team. So myself as the Chief Investment Officer of Warren Street Wealth Advisors, I'm a chartered financial analyst and certified financial planner. And the gentleman on the far left, Phillip Law, who is our most recent addition to the team. Phillip serves as a portfolio analyst. We headhunted him through Cal State Fullerton, through some mentorship work that I do there. I met Phillip in the honors program and then got to shadow him through his education. And he ultimately participated in a program there called Titan Capital Management, which is where they let students actually manage real money within the school's endowment fund. And I often remark Phillip's one of the smartest people I've met. He just hasn't figured it out yet. So that keeps him very humble as well. And I think it's fair to note, Phillip actually got some pretty robust offers post-graduation from some really large institutions in our business, and he believed in our team, and he believed in our values, and he chose to work with our team. And I'm extremely optimistic about his contribution to the team and his path forward and how that will ultimately impact all of our clients. So on that note, our clients, we can't do what we do without each and every one of you. This has obviously been quite an intense year, and we feel blessed and honored that you endow us with the partnership that you have and afford us the opportunity to serve. So thank you for that. So today's agenda, we're going to cover 4 kind of cornerstone points. First is going to be COVID-19, state of affairs here domestically and internationally. Phillip's going to take sections 1 and 2, so he'll walk you through COVID state of affairs, and then the economic overview, which will dovetail nicely into that, talking about economic output, employment figures. Then we'll get into the really fun stuff, the presidential election, some historical perspective, some forward-looking perspective, and I'll try my best to play nice. I know we've got an equal balance of all ideologies on this webinar, and our commitment is, it's really hard in 2020 to get unbiased information, whether it be through media or market pundits or whatever it might be. And that's really where we feel like we fit in, is to cut through the noise, meet skepticism and optimism in the middle with realism, and deliver to you guys an academic, informed perspective when it comes to things like investing and the economy. And then lastly, we'll talk about market performance. We'll talk about what COVID looked like for most major market asset classes. We'll talk about some of the actions we took early on in COVID and most recently. And we'll talk about our forward-looking perspective of some of the places that we deem to be most favorable over the next 5, 10, 15 years plus. All right, without further ado, Phillip Law, all yours.
Appreciate that, Blake. If 2020...
Phillip, I think we lost audio, or I lost audio. Let me see, might just be me.
All right, give me one.
I hear you now.
Is this better? Can you guys hear me?
Yes, sir. Thank you,
All
Justin.
Right. Appreciate that. If 2020 is Batman, then I think it's safe to say that the Joker has got to be COVID-19. And to talk a little bit about how the United States has responded to this villain, or this Joker, if you will, let's go ahead and dive a little deeper. I want to point everyone's attention to the chart at the top right. If you look at the blue line, which represents the 7-day moving average for daily coronavirus cases, you'll see that there was an initial spike towards late March/early April, and that was predominantly within the Northeast and the West. A few months later, there was another spike, this time in the southern states, Texas, Florida, and most recently, as I'm sure many of us on this call are aware, we just crossed the 100,000 coronavirus cases per day threshold, with that spread being predominantly within the Midwest and the South, regions there and states that are starting to show that COVID mitigation fatigue. Now, we know that the nature of this virus is that it spreads exponentially, so it's going to be imperative to keep an eye on government response and whether that government response is adequate and swift. We've seen certain states have the willingness to enact precautionary measures, whether it be draconian lockdowns or curfews. Other states have chosen to prioritize economic health. We believe that the right answer lies somewhere in the middle. Something else I want to talk about is the fatality rates, which fortunately look a lot less critical than they did earlier in the year. And that's due to a multitude of reasons. Number one, a lot of the virus spread early on was in skilled nursing communities. So that was where people with pre-existing conditions resided. And also number two, our hospitals were ill-equipped and ill-prepared to fight that virus early on. And you could see that as hospitals were being pushed to maximum capacity. You fast forward that to today, it looks a little bit different. If you look at the chart at the bottom right, and if you look at this green line, you'll see that the majority of virus spread and the case growth is actually amongst the younger generation. And obviously, younger individuals do have more robust immune systems. They can weather that virus storm a little bit better. So fatality rates have actually compressed downward, as you naturally expect. With all this in consideration, we at Warren Street, what we're focused on is, if the states do choose to not enact these draconian lockdowns, what is that going to do to the hospital loads? We're aware that certain states are already seeing record hospitalization numbers, and we're aware that certain rural communities may not have as robust of a medical support framework as some of these major metropolitan areas. So taking all of that into consideration, how is that going to affect the data that shows up in the ICU occupancy or the hospitalization numbers? So I touched on ICU occupancy data and hospitalization numbers in the last slide, but I want to talk more about why those are more reliable metrics when you're looking at COVID-19. Case count data by itself can be a little misleading just because someone can test positive for COVID-19 and not show a single symptom whatsoever. Besides, it's not going to be one person testing positive that's going to do a blow to the economy. What's going to hurt our economy is if our healthcare system starts to get overwhelmed, right? So if we run out of workers, doctors, nurses, people on the front lines, and we don't have enough of them to be able to provide that care that's desperately needed. Or for example, if our hospitals start to be pushed to the brink of capacity to the point where we don't have enough ICU beds to go around, that is what is going to cause an increase in those fatality rates. And that is what is going to more so incline our governments to shut down, causing that economic hurt. And recently, we've seen that the data coming out is worrisome. You'll see that early on towards March and April, a lot of the hospitalizations are actually centralized within the New York and New Jersey region. And a few months after that, we hit another peak hospitalization number in the summer, this time within the southern states. And most recently, we blew those past two record hospitalization numbers out of the water. And this time, all the hospitalizations are just coming from a little bit of everywhere, but mainly being centralized in the Midwest. And those hospitalization record numbers show no signs of slowing down. So just here's a little bit of a visual graphic to see how and as you guys can see, a lot of the states are concentrated with record hospitalizations within the Midwest. And just 2 days ago, you had 17 states report record hospitalization numbers. And even states such as Colorado have come out and said, hey, if the virus continues to spread at the rate that has been spreading, our model indicates that by the time we reach year end, our hospitals are going to be at maximum capacity. So that is fueling that wall of worry we do have. Next, I want to take a step back and talk a little bit outside the United States. When looking globally, East Asia is actually the region that has exhibited the best health response to COVID-19. But I want to instead talk about our Western neighbors a little bit, and that's Europe, right? Europe initially was terrified from the data that was coming out of Northern Italy, and that's why they were quick to shut down. They're also quick to pass a unified stimulus package. Not a stimulus package for each of these individual nations, but instead a stimulus package as the European Union, some newfound unity that we haven't seen in quite some time. And the results were commendable. They were able to mitigate that virus curve and eventually attempt this return to normalcy, which was unfortunately met by the second wave of COVID-19, as everyone can see towards the right tail end of the chart. And because of that second wave, that data coming out has now been troublesome. The spike in cases have prompted certain governments to enact stricter measures. For example, France and Germany have come out and stated mandatory 30-day lockdowns. And countries such as the United Kingdom have upgraded their COVID alert systems to the highest level in certain regions. So the good news, though, is that a lot of that response is very uniform across the board for each of these individual nations. And you compare that to the United States, where each individual state is kind of doing its own thing. The bad news, however, is that the second wave of COVID-19 is going to cause some economic setback to the catalyst that Europe had going for it, whether it be Brexit continuing or European banks exhibiting some form of a recovery. All in all, if we do continue to see that data deteriorate within Europe, our goal would be to see a willingness from the European governments to endure some form of short-term economic pain until we do get that vaccine. Now let's talk about the ends to the beginning, which is hopefully a vaccine. Currently, we have 11 vaccines in the final stages of testing, with 6 of them being approved for early/emergency use. Now, none of those 6 are currently manufactured by the United States, but Pfizer is expected to be applying, and hopefully we can get that on its way. Right now, it's of expert opinion that we're not likely to have a vaccine until midway through next year, but we wouldn't be surprised if we saw a vaccine come earlier than that time frame. Given the amount of success we've seen in clinical trials, for example, Pfizer announcing their 90% efficacy rate with their mRNA vaccine. But even if we do get a vaccine earlier than expected, there are still a lot of largely unanswered questions. For example, who's going to get immunized first? Is it going to be our doctors, nurses, those healthcare workers risking their lives on the front lines? Or is it going to be the elderly who are most vulnerable? What about large-scale distribution/development, right? Pfizer's mRNA vaccine requires to be stored in negative 80 degrees Celsius temperatures up until the point of injection. So to be able to transport that and send that out through a distribution network is going to present its own challenges. Next, I want to point everyone's attention to this chart on the right. And this chart represents the number of vaccine pre-orders per person for each of these individual countries. So far, we've seen certain countries have a willingness to spend money on vaccine manufacturing and research, which is a big investment in public health. And it's kind of like an arms race, actually, to see who's going to be able to get a readily available vaccine first. In the United States' case, as of late September, the United States had 5 vaccine pre-orders or vaccine doses pre-ordered per individual person. Now, not every single one of these manufacturers, vaccine manufacturers, are going to make it through clinical trials. But the goal here would be to have 2 to 3 candidates that are readily available for market consumption. Ultimately, it's most important that that vaccine is just reliable, safe, and readily accessible. So that's a little bit about the Joker, COVID-19, and now I want to touch more so on the general state of our economy. So I wanted to show this chart just to really reveal how unprecedented some of the data coming out in 2020 really is. If you look prior to 2020, you'll see that GDP, which represents gross domestic product, it's a measure of our nation's economic output. Think of it as a proxy for our nation's economic health. You'll see that in the 3 years prior to 2020, GDP looks like it grew at a relatively stable rate. And then you jump forward to the first quarter of 2020, you see a 5% GDP decline. And then just the quarter after that, we saw something we've never seen before. Gross domestic product declined 32%. And then the third quarter, just 3 months later, we saw something else we've never seen before, which is GDP rising almost 33%, or a bit over 33%. So there is resiliency within our economy. People have learned to adapt to this pandemic. Businesses have been able to adapt and take their operations online. And even pockets of the economy, like residential real estate, have shown signs of strength. So there is that resiliency there. But I also do want to highlight that just because we were able to recover 33% in the third quarter, which is more than how much we declined in the second quarter, doesn't necessarily mean we made up those economic losses. First of all, that 32% decline in GDP in the second quarter is coming off the heels of a 5% decline in the first quarter. Secondly, I want to make this analogy of where if you have $100 and you lose 50% of it, you're left with $50. If you try to gain that 50% back that you lost, you're only left at $75, not your original $100 amount. So we have rebounded 33%, which is a good sign, but we have to keep in mind that that rebound is coming off a very depressed figure, and by no means are we out of the woods just yet. Next, let's talk a little bit about both you and me, the everyday consumer. Consumer sentiment currently is actually at the lowest it's been in the past 5 years. The last time it hit a low was in October of 2016, and the figure here was at about 88. Today, it sits at 81.8. And I think it's a really good sign that consumer sentiment looks nowhere as low as it did back in the 08 and 09 crisis, all the way back over here. But it does run the risk of deteriorating just given the amount of uncertainty that's with the economy and the amount of uncertain headlines that are circulating the news. Next, I want to talk a little bit about some spending indicators, US retail sales and US personal spending. You'll see that both these indicators relative to 2020 look like they grew at quote unquote stable rates, again, relative to 2020. And what you'll see in 2020 is a dip followed by what looks like a V-shaped recovery. Now, that V-shaped recovery is largely in part due to the stimulus package, where consumers are getting those direct payments to supplement the cash they were spending. Businesses were getting those PPP loans and being able to, at the end of the day, trickle down the money to be able, so that consumers would be able to have it in their wallets and they could go out there and spend. Most recently, however, we have seen that V-shaped recovery lose steam during the summer months. And what happened during the summer months? Well, the stimulus package expired. So the lack of a stimulus package is evident in these consumer indicators and how they're doing. So the question now remains, how are consumers going to do, and are they going to be able to weather the storm until we get our next stimulus package? And also, what is the holiday shopping season going to look like? Is it going to look a little bit different than the years prior? So that's just some food for thought. Lastly, I want to talk about unemployment. Unemployment, or U3 unemployment, which is represented by this blue line, hit a peak of 14.7% in April. And then since then, we've made some good headway in terms of an unemployment rate recovery, whittling that down to 6.9% today. However, I do also want to bring everyone's attention to this gray line, which represents the US initial claims for unemployment insurance. It's essentially the amount of people that are filing for unemployment benefits for the very first time. And as everyone can see, that number has remained elevated despite an unemployment rate recovery. Next, I want to also touch on the U6 unemployment rate. Think of the U6 unemployment rate as a total measure of unemployment, where it's factoring in the U3 unemployment, but it's also considering discouraged workers, people who have given up looking for work, and people who have part-time work but are really seeking full-time work, the underemployed, as we call it. That number still does remain elevated. And you'll notice that a lot of people within the U6 unemployment rate are actually represented by some of the regions that have been hardest hit by the pandemic, whether that be entertainment and Disney, or whether that be the airlines, or even retail. So here are just a few headlines, scary headlines that to kind of represent those industries. But all in all here, we believe that the longer that this pandemic goes on, the more permanent some of these job losses will become, the more permanent and elevated the U6 unemployment rate will remain. So that's it about the general state of the economy. Now I want to pass it off to our Chief Investment Officer and founding partner, Blake Street, to talk a little bit about the elephant in the room, the presidential election. Blake?
Thank you, Phillip. Great job. And I told you we were going to balance skepticism and fear and hopefully inject some optimism and end up at a realistic perspective. And certainly a lot of scary data points out there. Also some more optimistic developments happening in vaccine land. We do at some point expect another stimulus bill. Just we don't really have a grasp yet on quite how large it will be. But I would expect that potentially sometime in the next few months, or obviously post inauguration of the next president. I would imagine that would be something on the desk quite quickly. So the presidential election, I get the really fun part of this presentation. And before I jumped into data, I wanted to start with, I understand the news is sensationalizing kind of the experience we all just lived through, but I wanted to bring some normalcy to it. And I wanted to bring some normalcy to it in the sense that I understand votes are still being counted and elections are potentially still being contested and recounts are being asked for. And I realize it's a hot button issue. It's sensationalized to the nth degree. But I want to talk about how some of the states that are still counting are very close, like razor thin close, within thousands of votes. And those are the ones that are being talked about. There are a myriad of other states that are still counting, including New York, that still, I believe last time I looked, had only counted about 2/3 of its votes. Obviously, it was called blue very early on. California, believe it or not, we're still counting votes. We're almost done, but mathematically, obviously, it was very blue early on and able to be called. But it's quite normal not only to allow a state the full timeline to count votes. California, it's 17 days post-election, as long as the ballot is in fact postmarked correctly. That is normal. Then throw on top of that the fact that we had record turnout, and on top of that, we had record mail-in voting. And some states weren't even legally allowed to begin counting those mail-in record ballots until the night of the election, or the day of the election, rather. So it's actually a sign of health that we're still counting. It is a sign of health that if there is anything questionable going on within particular races, that recounts and hand audits and things are administered. I still have full faith in our election process within each state. I realize there are players on both sides potentially politicizing and not playing nice and playing by the rules and trying to, you know, I guess not be fair to the electoral process. But at the end of the day, I do believe that America's voice will be heard and we will have the right president come January 20th of 2021. All right, so with that being said, let's jump to the next slide. So volatility is something that we are no stranger to now in 2020. And obviously a lot of that has had to do with COVID, but from a presidential election year perspective, volatility is also just quite normal. And the first thing I'll call your attention to is on the top right-hand side of this graph in yellow. I want to draw a distinction between what volatility looks like in election years versus non-election years. And the way we measure volatility is via standard deviation. And all I want you to think of that as is, we all talk about averages. We all talk about what the market does on average. And volatility is just a measure of dispersion around that average. So some years the market's really, really up, some years the market's really, really down, and you come to your long-term averages. That is volatility, or that is dispersion. And it just so happens that historically, there is a marked difference, you'll see in blue in that yellow box, in election year volatility in the months where we're all living through these highly polarized headlines, September, October, and November. 2020, there's obviously other factors at play like COVID, but we saw that September and October were very volatile. October, in fact, the US market was down roughly 7%. November, the market's off to a very strong start. And it's important to take note that volatility is actually a measure of volatility on both sides. So when you have a standard deviation on the positive side, everyone's very happy. And when you have a standard deviation on the negative side, everyone's very sad. But that being said, volatility is normal on both sides of the averages. The thing I think to take note last year is in the month of December here at far right in the graph. It's almost as if in election years, people are so fatigued about paying attention to their portfolios and trading and institutions trying to outsmart one another that everyone just goes and enjoys their holiday season. Contrast that with a non-election year, which is the far right bar. I guess that's a teal color or an aqua color. Volatility is actually very high in Decembers on non-election years. And we actually expect that because in a lot of years, people are harvesting losses, they're harvesting gains. A lot of the trading activity increases in the month of December. So I can't tell you that this is exactly how 2020 is going to play out because there's going to be other factors at play, including COVID third wave and a potential stimulus bill, much of which I hope are optimistic outcomes or positive outcomes that make the volatility on the right side of the average, but that remains to be seen. So volatility is very normal, not just in our personal lives and our Facebook feeds and our holiday conversations and election years, but it's certainly normal within the portfolios that we oversee. Some more long-term perspective, I think it's, safe to point out we expect a noisy first year post-inauguration, regardless of who the president is. So in this graph on the right-hand side, in the first year, you'll notice first years tend to be the worst year post-inauguration for any president, Republican or Democrat. Last years of the term tend to be the best. But I think what's important to clarify is all of these numbers are positive. And that's a good sign, right? And you'll often hear me remark that presidents are more so cheerleaders than anything for the market. You don't need to have a Republican or a Democrat in order to have a positive market. Take a look on the right-hand side of this graph. The dark blue lines are going back to 1789, so roughly 230 years, how have markets performed in the first 2 years post-inauguration for a presidency? The best performing 2-year periods have actually happened at the far right there in a Democratic presidency with a divided Congress. This is the most likely scenario of what we're obviously looking at for the next 2 years post-inauguration. 14.5% returns. If you go down to the next two scenarios, the two worst scenarios, you see a 1.1% return on average post-inauguration for a Republican presidency in a divided Congress, and a 3.4% return for a Democratic sweep. The reason I point out the Democratic sweep is that's what a lot of the pundits and the polling data said we were going to get. And that's what a lot of market participants were potentially trying to price in and figure out. So there is disparity in the first 2 years historically post-inauguration. And that could make you more bullish, more bearish based on what you agree or don't agree with. But I think the most important thing to take away from this is instead look at the light blue line. Look at the long-term average of 4 years post-inauguration. It doesn't matter what the makeup of the 3 branches of government are from a long-term perspective. You're talking about a range of roughly 8.5% to almost 11% in long-term averages, regardless of the composition of the 3 branches of government. Still the best combination is a Democratic presidency with a divided Congress. I think this is a little bit of an overplayed talking point, but what a lot of folks will tell you is the reason markets perform best with a divided Congress or a split government is because you had the checks and balances and you have status quo. So businesses can do what businesses do, which is invest in R&D, invest in manufacturing, focus on selling products, not trying to game plan tax bracket changes or tax code changes and things like that. So markets and economies and corporations like normalcy, and they like that check and balance, which is one of the reasons why they tend to prefer, again, a divided Congress that maybe potentially differs from who's in the presidency. Next slide. So this is just to further kind of drive home the market does not care who's president over the long term. This chart goes back to 1933 and takes a look at $10,000 invested in the S&P 500. Fast forward to today, compounded, and breaks it up into Democratic presidencies and Republican presidencies. And it's a pretty powerful view just to see the power of the compounding dollar. I want to be fair in that there's a couple of things at play here. Number one, I think if we were all in the same room right now and I asked everybody, raise your hand if you knew anybody that bought the entire market in 1933 and held and never sold anything, no one would raise their hand. Also, investing's changed. It's very easy to invest nowadays and to buy the entire market or to buy a broadly diversified fund. Not so much the case in 1933. This chart also doesn't take into the consideration taxes and commissions and trading costs, which we are very aware of and careful about managing today, but some of those things were very hard to avoid even as recent as the 1980s and early 90s. All that being said, I think this is a powerful chart to drive home the fact that, we're all just ants in an ant farm trying to build a better home. And we try and go out to work every day, trying to produce better products, services, and to grow and leave a better, generation, or leave things better for our next generation, if you will. And that's a powerful phenomena. And that's why folks that have focused on investing their capital and putting it at risk over the long term tend to be rewarded for it. And that is not a Republican posture. That is not a Democratic posture. It's a risk-taking posture. So net, I think our biggest takeaway from this is regardless of who's in the office of presidency, remember they're the cheerleader. They're not going to dictate market returns one way or the other, as much as the talking heads on TV might tell us otherwise. So let's talk a little bit about markets. Just how bad was the beginning of this year? It was really bad. It was scary. I remember sitting there in the first few weeks of March with a lot of panic calls coming in and trying to maintain my conviction and my calm and talk people away from the ledge about going to cash or getting out of the market. And it was a tough stretch. And here's some numbers to substantiate just how tough of a stretch it was. Far right-hand side of this chart I guess that's fuchsia or pink. My wife's on this webinar. I'm pretty sure she's going to kill me for not knowing my color palette. U.S. real estate down 43%. Small cap U.S. stocks there in tan at 41, down 41%. The next three are emerging market stocks, U.S. stocks, and international stocks, all down between 33 and 35%. The next one I think is the most surprising to me, the gray bar, which is U.S. corporate bonds. Bonds are often seen as like a steady investment or a safe investment. This was investment grade, so like very high quality companies, and their debt was down 15%, some as much as 20 to 25%, which was quite shocking. Gold, which has actually been the best performing asset class in our matrix to date, had a 12.5% downdraft. And then bonds. There was really no positive asset class through the beginning phase of COVID, other than short-term treasuries, if you were loaning the government for a very short-term time period, like 2 years. So no real safe place to hide. Let's talk about the recovery or the bounce back the other direction. This is gold off the bottom on the far right as of March 23rd through yesterday, I believe, up about 41%. The S&P bouncing 31% off the bottom, small cap US stocks bouncing 18. And then go over to the far left, US real estate has only bounced 4.1% off the bottom. So still a pretty dramatic difference in performance from one asset class to another. There is a section of this that I probably tend to be the most worried about, which is US Treasuries, US bonds, and US corporate bonds. And the reason for that is, you heard me talk about the cartoon at the beginning about Jerome Powell and the Fed playing their part. One of the things that the Fed did very early on was, in order to save credit markets or bond markets from freezing up and completely locking up and having a lot of trouble, is they stepped in to buy and soak up a lot of the demand that was there, or supply rather, that was there. And they bought hundreds of billions of dollars in bonds, corporate bonds, muni bonds, commercial-backed bonds, pretty much anything and everything to keep the credit markets from completely locking up, which is what we saw back in the subprime crisis. And this is a good thing for short-term market function, but at the end of the day, you want a normal, healthy market that's functioning, where every time you go to trade something, there's a willing participant on the other side that has a relatively similar judgment on value to what you have. And the Fed's backstop, or the Fed's willingness to buy certain types of bonds, will eventually wane. And if rates are artificially suppressed, which they are, and yields are really, really low like they have been, you have to be very careful about the type of bonds that you're buying. You can't just go scatterblast and buy a little bit of everything. You can't just go buy one type of bond. You have to be very thoughtful about the type of credit you're putting in your portfolios. Zooming out to full year performance, this is a chart showing full calendar year January 1 to 11/11 performance. Gold again has been the belle of the ball. I didn't write that, Phillip did, I promise. S&P 500 has been the leader from an equity perspective. Most of the returns in the US market have been relegated to tech. So a lot of the FANGs, the Facebook, Amazon, Apple, Netflix, Googles of the world, Slacks, Zooms, have obviously benefited from the tailwind that is work at home, work remote, and consume digitally. And that's driven US performance to look very strong. The problem is, so much of it is concentrated within a particular pocket of companies that were expensive before 2020 happened, and now are just even more expensive. Emerging markets following that up, and all the way to the far left, you'll see US real estate still struggling. In the middle of the chart, in green and gray, that's corporate bonds and treasury bonds. That's the pocket that I just talked about being worried about, where the Fed is kind of providing that artificial demand, where you have to be very mindful about your bond exposures, both in who you're lending money to and also how long you're lending them money for. Let's talk a little bit about valuation and our forward-looking judgments. I see a question there. So we will have a time on the back end for Q&A. And if we don't get to your questions on this, we will absolutely follow up with each of you individually. And I do want to draw a distinction. The numbers you're seeing right now are on commercial real estate, which is generally more investable in the public markets, not residential real estate, because residential real estate we've all seen is just skyrocketed and done really well as mortgage rates have fallen. And we haven't seen the weakness of like mortgage forbearance and the moratoriums, eviction moratoriums and things cliffing off. So US residential real estate, we do expect to fatigue as well, but commercial has obviously had a very, very hard go in 2020. So back to valuation real quick. Valuation at the end of the day, we're all familiar with it in our daily life, but we don't maybe understand how to translate it into the markets. Valuation is really just what am I willing to pay for something relative to what I'm getting. So if you're going to a car dealership and you're buying a car, how much am I paying for how much horsepower? Or how much am I paying for mileage range? Or how much am I paying for the sunroof option? Same kind of rules apply on eBay. There's, kind of a live stock market-esque experience there where you're bidding on items and there's market participants trying to arrive at a value of what something is worth. That's the stock market. And when we're buying stocks, we are really buying a couple of different things. We're either buying the profits that a company's generating, the profits a company might generate, the revenue a company is generating, because there's a lot of companies out there that are doing a ton of sales but losing money. Think Amazon over the years, not a lot of years in which they've ever produced a net profit. And then the other is like the book value. So cash on hand, fixed assets, equipment, machinery, buildings, all of those things. So in stocks, you should always be mindful of what am I buying at the end of the day? And this is where a lot of investors get in trouble chasing hot stocks and tech and things like that, not understanding the valuation or the price at which you're accessing that company's opportunity. So on this right-hand side, in this chart, I'll try and explain this as simple as possible. On the left-hand side, you see price to earnings. On the far right-hand side, you see price to book. I'm going to start with price to earnings. And at the very bottom, you'll notice the countries that are being measured here. The United States, developed markets or developed countries, Europe, Japan, and then the emerging markets. So emerging markets are like Brazil, Russia, India, China, and most Latin American markets. Now for the actual bars themselves and the numbers themselves, I'll start with the US. The gray bar represents the range of valuations over the last 25 years of price to earnings and then price to book. The blue represents the average of that range. And then the blue diamond represents the current valuation or how things are currently priced according to the historic average and then according to the historic range. So the broad takeaway I want you guys to all have here is on a short-term valuation basis, the US is at the high end of the range. It is above average price. Contrast that with what we see in Japan, below average price, near the bottom of the range. Same thing in the emerging markets. So below average price, bottom of the range. US is cheap, international is expensive. US is expensive, international is cheap. Let's go back to that whole personal, this isn't actionable advice. Let's make sure we don't take action after this. That's why we give those disclosures, because we will make mistakes. Short-term valuations, though, are a blunt edge tool. This is not meant to say like, hey, over the next 3 months or 6 months, international markets will outperform. It's a little bit noisy. So why do we pay attention to it at all? Well, long-term valuation happens to be something that is really reliable for forecasting in terms of how am I going to build my portfolio for the long run. And most clients that hire us, that's what they're doing. They're hiring us to manage their money over 5, 10, 15, hopefully their entire retirement timeline and decades at a time. So we're really worried about like how are we allocating our clients' dollars, not on what did well over the last 10 years, but what we expect to do well over the next 10. And in the blue bar here, I'm just going to talk about the blue bar really, which is a measure of long-term earnings or long-term price to earnings. So it's a little less noisy. It's a smoothed out number. It's called the CAPE ratio. The gentleman who built it was Robert Shiller. He won the Nobel Prize in economics. And it's a much more reliable indicator in telling you, is something cheap, is something expensive, and what does that mean for me long-term? So at the bottom here, you'll notice I got emerging markets, developed European stocks, developed markets in aggregate, and then the United States. The blue bar to the left is the cheapest at about a 15 CAPE ratio, and then at the far right in the United States, it's north of 30. and I think instinctively this will make sense to most everyone, is if I buy things cheap, I probably do better historically than if I buy things expensive, right? And we all kind of were taught, over the years, or heard the old cliche of buy low, sell high. In order to actually experience that phenomena, you probably have to buy low. And CAPE ratios don't tell you that if I buy low, I'm going to get rewarded over a year, but they are incredibly reliable for being rewarded over long-term time cycles, 5, 10, 15-year cycles. So a willingness to not necessarily load up on what's expensive and has done well over the last 10 years, but a willingness to look different. And so these tiny little dots up here are the forecasted return based on CAPE ratios historically. So when you enter something at a 15 CAPE ratio in the emerging markets, your forward-looking valuation forecast is 7.7% real. That word real just means net of inflation. So if I add 2% of inflation onto this, you're expecting to do roughly a 10% return. Contrast that with the United States at a 30 CAPE. We've really only seen that CAPE ratio once before, and it was significantly higher in the tech bubble, but we're getting into that stratosphere, and we're in the top decile of long-term valuation range when it comes to the United States. So the United States is all anyone wants to talk about. US tech, there's this FOMO going on where people really want to own what's happened, and they're loading up all primarily in the United States. And eventually that trade will revert. Eventually that will get played out, and you'll start to see dollars chase cheaper securities, and that will become in vogue, and the complete opposite thing will happen. So using the CAPE ratio to predict forward-looking returns, this forecast tool is seeing 2.9% real, 4.9% gross if you use a 2% inflation factor. That is a far cry from the 8 to 10% people are used to in the United States of long-term returns. Hence why you hear us talk so much about international diversification, a willingness to invest where other folks are not. All right, so we're getting close to the end here. Looks like I got about 6 minutes, so I'll do my best to wrap up here succinctly. So one of the questions we get, I think the most is, okay, 2020 has been a really crazy year. What have you guys done? How have you taken in all this information, taken in all the demands from your clients and the fear and the paranoia, and what actions have you actually taken? So I think the starting point needs to be every client that comes through our door, we start with a proper amount of risk tolerance. So if your portfolio is built right initially, it should be built to weather extreme economic downturns, extreme market downturns, and to get you through your retirement trajectory. If you have to change a bunch because the market sold off 10, 15, 20%, you probably picked the wrong portfolio in the first place. So that's the starting point. If you look at the COVID sell-off starting, really the third week of February, February 28th, we did a firm-wide rebalance. We didn't know how bad this thing was going to be. We just knew there was extreme market action to the downside. So in a firm-wide rebalance, we sell the things that are holding up. So we sold gold, we sold bonds, and we started buying stocks. We started harvesting losses and weaponizing them for tax purposes, and we bought risk. We were a little bit early. Fast forward to March 12th, we did it again. We literally traded hundreds of households, hundreds of millions of dollars, and worth of portfolios. The same thing. We did another firm-wide rebalance. We sold bonds, we sold gold, we bought back into stocks. We harvested losses. And the thing we did different this time was we started increasing risk tolerance. So if someone wasn't taking enough risk or was comfortable taking more risk, we began encouraging it. We also started calling folks, existing clients, new clients, hey, do you have dry powder? Do you have cash? Now is a good time to start buying into this market. We were about 10 days early. I mean, we're not market timers by any means, but the market bottomed March 23rd and has since obviously had an uninterrupted bounce really through today. If you look at October 6th, in preparation for the volatility that we just talked about briefly, the COVID third wave, we started to take some chips off the table. So we reduced our tech stock exposure, we reduced our small cap US exposure, and we bought mortgage-backed bonds and we bought gold. In the month of October, this looked like a brilliant trade, obviously with the US market being down 7%. Excuse me one second. Forgive me. So we took some chips off the table, raised dry powder, and again, that was COVID third wave, that was election uncertainty, contested election, and I will say I'm surprised in November's performance. We've seen a aggressive bounce to the upside, but thankfully, the biggest bounce we've seen is in international stocks, primarily European value stocks, which is our largest holding, and a manager called Oakmark, who's been a total thorn on our side, our worst performer since the end of 2018, and probably the greatest linchpin in client complaints and conversations over the years. It's a manager we really believe in. It's an asset class we're extremely bullish on over the long term. You talk about a willingness to be where, it's not popular and buy early. That's an example of that. It's up 20% or almost 21% here in the month of November. So thankfully we didn't get out of that position, but we remain steadfast in the fact that we want some defensive posture through the end of this year. There's just a ton of stuff going on where we think we will be served well by that flexibility and being a bit on the defensive side. And that does it for our presentation. So we've got a few minutes. I know we've got 2 minutes roughly on the clock. But feel free in the chat section here to submit any questions, and Phillip and I will do our best to attack them. And thank you all for attending, by the way. We know how valuable your time is, and we appreciate you sharing some of it with us. And by no means don't feel obligated to stick around. If you do need to take off, we understand. We will follow up with you afterwards. And don't be scared if you do have a question.
We have a question. Can you hear me, Blake?
Yeah, go ahead.
We have a question from Mr. Dustin Riddle.
Riddell?
View on Riddell.
Yes, sir.
View on residential real estate in 2021 and beyond.
Good question. I think it has been anyways, hot of a seller's market as we'll probably see in terms of month-over-month returns. One of the big reasons for that is we were all staring at the same four walls during COVID. We were getting antsy. We had nothing better to do but then window shop. So, we're on Redfin, we're on Zillow, we're bugging our real estate agent and our broker to go see open houses. At the same time, mortgage rates were falling dramatically. I mean, this time last year, and maybe even a little bit before that, we had clients borrowing 30-year mortgages in the fours. In some cases, the high fours. Fast forward to today, we've had mortgages, 30-year mortgages, 2.5, 2.75, 2.875. And what that does is that increases a borrower's ability to pay a higher dollar amount and qualify for, which is a natural kind of tailwind to home prices rising. In Orange County specifically, real estate inventory was down about 40% over the summer. So it's just a perfect storm of a seller's market where, tight inventories, really loose borrowing, and nobody with anything better to do but then to look at new homes. All of those conditions are set to wane and fatigue a bit. So if we do see rates start to pop back up as conditions normalize and we get post-vaccine and the Fed starts to normalize Fed policy, and on top of that, you still have folks that are in mortgage forbearance. You still have folks that are on eviction moratorium, which means banks can't list bank-owned properties or foreclose. So all that being said, I do not love residential real estate from an investment perspective over the next 12 months. We're obviously 10 plus years into a bull cycle on residential real estate like we are in US equities. A little bit different if you're already an investor there and you're trying to decide what to do. I think, a prudent process for avoiding tax and whether to hold, because taxes are a great friction, as are commissions and all that fun stuff as well. So happy to take this conversation further offline because I think we have some other questions coming in. What else we got?
Dustin saying thank you, bud.
Oh, perfect.
Yeah.
And I see some thanks. I see very informative presentation. Thank you, Jared. Enjoyed having you. Maria, can you send the PowerPoint? Would be happy to send you the PowerPoint. We will make this whole presentation available to y'all, including the webinar replay and the PowerPoint slides. The last slide we have up here, we got a myriad of ways to interact with our team: email, phone calls, screen shares just like this. So just because COVID's made it harder to get together face-to-face, don't hesitate to invoke our team. We'll get into the trenches with you, whether it's your personal investments and balance sheet, it's your business, PPP loans, CARES Act. We've done it all this year, and part of the value and virtue in being an ensemble is just because I might not know something or Phil might not know something doesn't mean we don't have the experts like Justin and Emily and et cetera to jump in and provide value to you guys. Julie Cook, happy birthday, by the way. I meant to give you a little shout out at the beginning. Forgive me for almost missing you, but I hope your day was very special. Any more questions, Phil, or is that it?
I think that's it for the time being.
Russ and Mary, you're more than welcome. I hope to see you guys in a post-COVID world and normal circumstances very soon. Ramona, thank you. I'm sure I'll be talking to you soon. All right, gang. Well, thank you. That does it for our Where Are We Now presentation. Our team is here to help. Don't hesitate to ping us. And again, thank you for affording us the opportunity to serve.
Thank you, everyone.